Hey guys, hope you're well. Time for our September monthly chart pack update. We're going to go through our usual two reports. We're going to go through the CoreLogic report and the RBA chart pack report as well, just to get a bit of understanding of how the economy is going and having a look what's happening out there at the moment. First time seeing this as well, so I'll be interpreting it as well as you guys. Typical first page here, $9.7 trillion real estate market. Commercial is about 1.3 trillion. Our outstanding mortgage debt is still at the 2.1 mark. So overall LVR is quite low across Australia, and our household wealth in housing is now 57%. So nearly 60% of our household wealth is in residential property, which is pretty phenomenal. Total sales per annum is just under 600,000, and then gross value is around the 500 billion, which is pretty crazy numbers. So Australian dwelling values over the last 3 months went down 3.4%. 12 months was still up 4.7%. So we can see the downtrend is really happening over the last couple of months. But overall, on a 12-month projection, we're still positive for now. And in capital city, the housing market downturn is accelerating and widening. In the month of August, every capital city market except Darwin saw a fall in values. So with the constant RBA interest rate increases and inflation continuously getting high, people are a little bit skeptical about getting into the market, and we're sort of seeing that have an impact moving forward from here. I really like that sort of 3-month change cycle because it gives you a bit of a it's a short enough time frame to understand what's happening out there in the market, but also not big enough to not too short that the data can get quite skewed. With the 3 months at least, you've got 3 different months there of data and having a look and analysing how they're rolling out, and not like you're not looking at a 12-month, which is a bit slow, or not looking at like a 2-week or a 1 month, which can be quite skewed with some bigger data numbers coming through. So regionals are down 2.1% and combined capitals are down 3.8%. So capital is taking a bigger hit there, obviously, than the regional side of things. But we can see on a sort of longer prolonged period, they're not too dissimilar in terms of where they are together now. When we sort of go back in time, we can see that in some markets they are quite different, and they start to be trending suit together. So it's not like regionals or capital cities are performing differently. The capital cities are getting hit harder, but regional cities quite tend to follow the capital cities either anyway. So good to sort of see that and understand that we've had a long sort of period of growth there after the 2019 election. All through the pandemic, we've had some pretty significant growth, and now the cycle's starting to come down again here. What's interesting to note is we're actually at the lowest level we've ever been since recorded history back to 2012 in terms of the growth rate on an annualized basis. So something very interesting to note there. I think, not saying that it is the bottom of the market, but it's now Wednesday, the 7th of September. The RBA just increased the cash rate to 50 basis points yesterday. In my personal opinion, I feel like this is the last 50 basis point rate increase that they'll do. They may continue to do, sort of 25 basis points or 20 basis points or something a little bit less. I do think they still might increase, but I don't think they're going to be increasing at 50 basis points. That's my personal opinion. Could be completely wrong. And I think, not saying that it is the bottom, but we are sort of getting quite close there in terms of where this number lies and what's happening out there in the economy. In their board meeting minutes, they continually suggest that inflation should be coming down as early as next year. And so when we start to see inflation taper off, that's when they might decide to reverse some of those decisions around increasing the cash rate. So interesting point in the economy we are now. When we look at this, a 12-month rolling change, regionals are still up 13%, so that's the sea change, tree change, people all getting out of capital cities away from lockdowns and the pandemic, and the combined capitals are only up 2.2%. So definitely see these regionals following the trajectory of combined capital cities, but they have definitely outperformed during the COVID pandemic, and hence why their number is still 13% growth in 12 months is still quite significant. Comparing sort of where we are in the economy and what we've seen over the last 6 months and the change within that. So everything is on the downward trajectory. Adelaide is still positive 1.6. Sydney is leading the pack at nearly negative 6%. Melbourne's following suit at negative 3.8. Brizzy's not far behind at 2.5. What's interesting to see here is that Sydney and Melbourne really started coming down, prior to August 21 here from the graph, and it's had a slow trajectory all the way down, whereas something like Brisbane continued to grow for the next sort of 6 to 12 months after, and now is starting to rapidly deteriorate compared to Sydney and Melbourne. And that might be things, number one, people following suit, but number two, the pandemic also, or lockdowns opening up, which means less people are moving to Brisbane. Additionally too, we've got that land tax talk that's been coming through, or now it's passed legislation, but there had been a lot of talk previously about this new land tax coming into play and having a bit of impact on things. So interesting to see that rapid decline there. And then Perth, Hobart, Darwin and ACT is all sort of on the trajectory, apart from Darwin, as CoreLogic mentioned before there. They're still positive 2.3 and on the way up. Very interesting. Leading the pack is the higher 75th percentile. So these are all the really sort of great, expensive blue chip assets. When you start to take wealth out of, when you start to impact higher net wealth individuals, they start to pull debt back down, and there's only a limited number of those. Whereas there's a lot more people, everyone that can afford the bottom 25 percentile is in the 50 and 75th percentile, but not everyone in the 75th percentile can afford the 25th and not everyone in the 25th percentile can afford these two top, where if you reverse it the other way, it tends to happen. And that's why we start to see those unit and housing markets cycle differently, right? Because in a time where we went through the pandemic, all the houses were going really well, people had money to spend, they could afford houses. And now we're going through this transition where houses are still expensive, and maybe they're too expensive, borrowing capacities are coming down, and so now people can only get into lesser quality assets. And this is when they start to go into subpar assets like units or apartments or flats or townhouses, get into a different tiered market that's more affordable. And it's funny because you start to see, the prices of units and houses come together during these times. At least that's what I've seen historically anyway. But we can see that this upper range of the 75th percentile is driving the negative growth much more heavily than the rest of them in the top three of the major cities. So pretty interesting to watch there. Housing cycles. So the rolling 20-day growth rate in CoreLogic Daily Home Index, the 28-day change in combined capital cities value index fell a further negative 1.6% through the 28 days to August 31st. The rolling 4-week change in capital city values has been in negative territory since mid-May, with the rate of decline accelerating at successive cash rate rises. Yeah, spot on. Interesting enough though, what we can see apart from the last little pull down, we're actually starting to flatline around this sort of negative 1.5% for a little while, since July essentially. 28th of July. So all through August, it was pretty flatline, and then we've had this another little drop down here now to 1.6. And so, this was a steady drop down line essentially from May to August 4th, or the 4th of August, and then we kind of flatlined there. And now we're starting to see that little downturn again. So it might be interesting to sort of see if it flatlines again or it continues on that downward trajectory. Interesting sides there. So Sydney, down negative 2.3% in the August period. Over the quarter, it's down nearly 6%. So if you take that on an annualized basis, 6% at 3 months is something like 20% or something crazy. So it is a rapid decline rate, and you can see by how sharp this downturn is here as well. Over the past year, we're now negative at negative 2.5, and we're negative 7.4 below our record high. So nearly getting to those sort of 10% property fall numbers that everyone sort of spooks and talks about and gets new media headlines and clicks. But we are coming off quite a large high that we went through during the COVID period as well. So Melbourne is now negative 2.1. Over the quarter, we're down negative 3.8. So not as heavy as Sydney, and we're now down 4.6% from our peaks. Not as high as Sydney. I feel like because Melbourne went through lockdowns during the COVID pandemic, the market didn't perform as well as the Sydney market did. And so, when you're coming off a lower base, a lower high, as they say, you're not going to have too much more of an impact from that side of things. Brizzy, it declined nearly 2% in August. Over the quarter, we're down -2%. So now we're really starting to see that quick downturn start to happen in the Brisbane market. We're still up over 17% over the last year, but overall we're -2.6%. So nothing too surprising there. It's going to be interesting if it follows suit and ends up going negative, and how quick that rate of decline is starting to happen. So this will be an interesting market to watch, especially with the land tax coming through and investors potentially pulling out of the market there, which I think is really bad for the local economy over in Brisbane. The rental market over there is insane. We've actually, my wife and I have decided to potentially move to the Gold Coast. So we've just been having a look at options on, we flew over there last week. We had a look at, what's in the market, what can we get, where is the local market, and what are the boots on the ground like over there, what's the atmosphere. It's still okay, everyone's a little bit shaken up and wants to get deals done quickly and all that sort of stuff, but it's, the values are still holding relatively straight for those who had pre-approvals prior to a couple of interest rate increases. But we're also like, well, why don't we just go and rent there for a little while and then buy something over time as the market starts to come down. And the rental market over there is crazy. Places are going for like, $2,000 a week sort of thing, where you can buy something for 1.5-2 million. So it's pretty ridiculous. And I think this sort of whole land tax thing will, if it potentially rips property investors out of the Brisbane, Queensland market, then it's only going to make that rental market worse, because you're ripping supply off the market, and it's going to have a negative impact from there. So yeah, it's going to be really interesting to see how long that stays into play, if it continues to go through. Adelaide is starting to see a bit of negative growth now, but still up 21% on nearly 22% for the year. Now we're starting to see those downward trajectories come into play following the Brisbane trajectory. It's not as sharp, it doesn't look like as yet, but we are definitely on the decrease. Perth looks like it's gone through its down cycle and starting to level out now. Dwellings declined in August, but we're still up 5% over the last year. So definitely over the hump, and it'd be interesting to see if it does go negative overall. Hobart, we're now on the big down trajectory. We're still up 6% over the year, but declined nearly 1.7. It did decline 1.7 last month, and we're down 3.3 for the quarter. Darwin is up for nearly 1%. Over the quarter, we're up 2.3, and over the last year, we're up about 6.3. So not following suit compared to the rest of the market across Australia from here. Canberra was still up 7.8% for the year, but we are down 1.7% for the month, and then down 2.6% for the quarter as well. Sales and listings. So national sales volumes are trending lower as buyer demand slows. CoreLogic estimates that in the 12 months to August, there were 574,000 sales nationally, down 2.3% compared to the previous years. Sales estimate over the 3 months to August were down -14% lower than the same period last year. So that's pretty interesting to note, is on an annualized basis, sales aren't down as bad. It's only 2.3%, which, within a bandwidth, I think that would be quite normal. But interesting that the month of August was actually down 14%, which is quite dramatic to last year. I can't remember exactly when the lockdowns ended, but there wasn't a lot of transactions happening during lockdown, so there might have been like a bit of a surcharge after the lockdowns ended, and now it's seeing an impact. But we're definitely seeing sales slow down with all these changes to interest rates and the cash rate. So interesting to note there. That's quite a bigger drop, nearly 15%. Median days on market. So at the national level, properties are taking longer to sell. In the 3 months to August, the median days on market was 33, up from the recent low of 20 days over the 3 months to November. So yeah, our lows down here is getting closer to 20 days on the market, which means, things weren't even going through a normal auction campaign. I mean, a normal auction campaign is about 4 weeks. So that's about 28 days. And they were selling within 20 days, so things selling prior to auction, which is really interesting. Now we're back up to sort of 31, 38 days. So typically what that would mean, and every market's It's different across Australia, but typically that would mean that you'd go through a 4-week auction campaign. The property would pass in on day 28, and then you'd have 3 to 7 more days there to negotiate on the property, reset the vendor's expectations around what the value of their property is worth, and then get a deal done within the next week to settle on that property. Vendor discounting. So vendor discounting has been increased from the recent low of negative 2.8% record in the 3 months to April last year. In the 3 months to August, the median vendor discount at national level was down 4%. So vendors are now discounting their properties from what they were listed for. Happy to start to bring that down. The lowest we've seen on this graph here is just under 5, or above negative 5. So and now we're at negative 4.1, so we definitely are starting to come down again. Vendors are deciding to discount their property. In the 4 weeks to September 4th, there were 35,000 newly advertised dwellings on sale nationally. While the volume of new listing has trended lower, the flow of new listing is higher than the previous year and is expected to rise in the coming weeks. So this season in the market heading into spring is generally a good, a lot of properties come on the market because the sun shines out, grass is growing, the plants look great, the sun's out, we've come out of our winter hibernation, it's not sort of raining anymore or cloudy or gloomy every day. Good spring selling season, and so we start to see a whole bunch of new listings come out onto the market. We can see that we're actually still higher in 2022 compared to every other year apart from 2018. So we're higher than 2019, 2020, and 2021. I think the pandemic started in 2019, so that would make sense. I could be wrong there, but yeah, it's interesting to note. As you can see here, this sort of September, October, November, there's a lot of listings that come onto the market between now and then. So starting to look like there's going to be a fair more listings come on the market. Sorry. At the national level, the stock of total listings is gradually rising as properties take longer to sell. However, advertised stock remains well below the average for the same time this year. So this is total stock on market rather than new listings. Pretty flat throughout the year. There's typically anywhere between 150 to 220 properties on the market across the country. So we're just below that sort of 150 range. We're down sort of 22% from the 5-year average, but we are up compared to last year as well. So interesting just to sort of see how that plays out over the year. The total advertised stock levels remain somewhat low in regional Australia. Total stock levels are far higher than the equivalent period of 2021 in capital cities, when sales and listings activity was constrained by social distancing measures. Yeah, pretty interesting how it was just crazy going to open homes and all that sort of stuff during the pandemic. Only one person at a time and everything else like that. So pretty interesting. Clearance rates averaging around 56%. So typically anything above 60% would be considered a seller's market. Anything under 60% would be considered a buyer's market. So it's not too far off. Worst we got down to was closer to sort of 50%. So definitely still in a buyer's market, I would say. But it's not too, it's not like it's a crazy buyer's market. There's still things that are selling on the market, and it's going to be interesting to see how this rolls out over the next spring selling season as well. Rental rates, so national rent values rose 10% in 12 months to August. 10% is insane, which is the new record high growth rate. Rent value increases are fairly broad based, but the pace of growth is slowing in some similar capital cities. So up 10%, which means, if you were renting something for $500 a week, it's now going to be $550 a week, which is a crazy amount of growth for a 12-month period. I want to see, so Brisbane is the lead here at a 13% increase. So, if you're renting something for $1,000, you're now paying $130 more than you were last year, which is just crazy, considering that the cash rate's going up and inflation's going up and the cost of living's going up. This is what I mean with the rental market over in Brisbane. Sydney's still up 10%, which is crazy too, and Adelaide is up 12%. Yields, so through August, So this is essentially a reflection of rents going up, right? So as rents go up and now property prices are starting to stagnate or come down, those yields are coming up over time. Australia's gross rental yield rose 3.5% up from the recent low of 3.21% in January this year. Rental yields are likely to trend higher on a broad basis as property values decline. Yep. So as rent comes up and property values come down, our rental yield comes up as we start to go along. Regionals is averaging around 4.2. Combined capitals is around 3.3. Dwelling approvals. So the number of residential dwellings approved for construction dropped 17% over the month of July. The sharp drop was due to a 45% decline across the unit sector due to the lack of high-rise approvals. Housing approvals were up 1% over the month, trending roughly around the decade average of nearly 10,000 since January. So big drop off there, which is really interesting, driven from that unit sector. So a lot of units not getting approved or applied for, I guess. But what does that do? It just means that there's going to be less stock coming onto the market in sort of 9 to 18 months from now, which plays with that supply and demand side of things. So if you think about it on a bigger picture, if we start to open up migration, if we start to get out of this pandemic and the economy starts to average out and things start to get back to somewhat of a normality and more migration comes into the country, and we've got less and less properties on the market from new buildings and new approvals, and more demand, then it should theoretically increase the price where there's less supply and more demand. So it'll be interesting to see how it plays out, especially if the RBA decides to reverse some decisions on the cash rate and it starts to come back down to a normal level. Be interesting to sort of see how that plays out, sort of 19 to 18 months down the track. Lending for property purchases dropped a notable 8.5% in July. Investor housing finance fell 11% in the month, while total owner-occupier fell 7%. So investor financing has dropped quite significantly, where owner-occupier has dropped as well, but not as dramatically. Value commitments, so our financing commitments have dropped down. Is this excluding refinance? It doesn't say that it's excluding refinance. This one. So portion of new lending for investment housing, and this is excluding refinances. So this has come down to 32.8%, where the average, I think this would be the 5-year average maybe, is 34%. So we are down, investors are down compared to the 5-year average. Investor lending, so nationally investor finance comprised 32.8% of new mortgage lending through the month of July. This is below the decade average of 34%, which is exactly what I just said before. The one coming down the most, Queensland's getting hit quite hard. WA, Tas and South Australia are still up. New South Wales down a little bit, but not as dramatically as Queensland, Victoria as well. So Queensland is definitely copping it on the chin there in terms of investor financing or investors coming into the market there. First home buyers, so nationally first home buyer declined 10%, just under 10% in July, faster than the overall owner-occupier cohort. As a result, first home buyer finance represented 21% of all owner-occupier finance through July, the lowest level since July 2017. So it's definitely those first time buyers that are getting hit the hardest with this cash rate increasing because they get lower borrowing capacity. They're not typically younger and not used to being in an economy that is a little bit unbalanced and wobbly. So less confident. Confidence comes out when that sort of starts to happen, and they might have pushed a purchase decision down the road a little bit. RBA increased the cash rate to 2.35%. That's what I was mentioning beforehand. Our 10-year average is 2.5, so we're getting closer to our 10-year average. And that's a really interesting thing, to say that our cash rate is now at a higher rate than it had been since, for the last 5 years. This is higher than it's ever been for the last 5 years is pretty crazy. We are, a lot of people sort of say, and you kind of look at this trajectory of the cash rate, right, and you go, it's always on a decline. There are a couple of bounce ups, but then it starts to come back down. But if you see how aggressive this push up has been from the RBA, it's just consistently on the trajectory up, where some of these previous rate rises, there was times of pausing and they assessed and everything else like that. You can see how aggressive this reaction is, and it's something that has never happened in the past before. So what we are really doing, or what I personally feel like the RBA are doing, is essentially this. They're waiting for inflation to peak at 7.75%, and then it's going to come down to 4% in 2023. That's their projection, and then 3% in 2024. So I think they're rapidly increasing this to deal with that inflation problem, and then I do personally feel like they will bring the cash rate down back to a normal, sustainable rate here. They're essentially wanting to pull out the crazy amount of savings that everyone got during the COVID pandemic, which they essentially stimulated and put in people's hands. So it was a bit silly, but trying to pull that all back out, slow down people, slow down businesses, get inflation back into order, and then bring that cash rate back down. Housing credit. So average long-term fixed rates have now increased to 5.19% for the investor segment and 5.06% for owner-occupiers through July. Average variable rates also trended higher in response to the higher cash rate. So the fixed rate greater than 3 years is now above 5%. The variable rates are now at 3.5%. And then for investors, we're up at 5.19 and the variables at 3.86. So pretty interesting to see a big jump up from the variable side of things. You can see how quickly the banks change their tune, and this is really good, something to watch, right? So the banks actually started to change their tune around November 20, and fixed rates have been on the trajectory up since then. They really started the hike sort of March to May 2021, and then it wasn't until May 2022 when the variable rate started to go up again. So the fixed rates are, in my mind, something really interesting to watch around what the banks think long-term, big picture, things are going to start to happen. And so when I really like to watch the major four banks as they start to change their fixed rates and the trajectory of their fixed rates, because it does have an inclination on sort of where everyone, they're paying big bucks for lots of people to have an interpretation on, no one really knows what's going to happen, but have their opinion and interpretation on what is going to happen in the lending environment. And so just a good one to watch for a sort of 12-month period of what might happen over that longer term. APRA data shows the amount of potential risky mortgage lending has generally trended lower through June quarter to 2022, with the exception of the portion of lending on interest terms. So percentages of loans on interest-only terms is around 20%. So and the 20% of people are going interest-only. 6 times income, greater than 6 times income is 10%, which is, has come up fairly significantly since March 2019, and that's purely just because the cash rate has come down so significantly. So, where we were at 5% of new lending above 6%, we're now at 10%. It's almost doubled, which is quite large. Loans with a percentage of loans originated with a loan to income ratio greater than 6 times. Loans originated with a debt income. Okay, interesting. So now again, still we've gone from 14% a debt to income to now sort of 20%. If you go sort of peak to trough there, it's almost a 10% jump, which is pretty crazy as well. And then percentage of loans on higher than 90% LVR, so a little bit riskier lending there. We peaked in December 2020 at 14%. We're now down to 8.3%. So banks want to be less risky with lending more than 90% LVR, which means people are only using a 10% deposit, which makes sense because the market's on the way down and they don't want to be caught out and in a bad scenario where they had to force someone to sell a property and they were negative equity and lost some money. Cool. So that's a CoreLogic chart pack. Pretty interesting. I always love going through that. Plenty of detail to go through there. I just want to go through the RBA chart pack as well. There's typically a few things that I like to look at this. GDP growth over the world. No, I don't want to see the world. I just want to see Australia. So GDP growth. I actually do want to see the world, but we are talking about Australia. Is continuing to trend down since last month. We're down to nearly sort of 3.5% from here. So the growth overall is starting to slow down. Contributors to GDP, biggest one is consumption, and government. So government's spending quite a fair bit, plus we're also consuming quite a fair bit, which is why inflation comes into play. Household income and CPI inflation, again, we're still at 6.1%. I heard somewhere that we're starting to go to monthly CPI calculations instead of quarterly. So that'd be super interesting to see, and I think much more valuable than only getting reported every quarter. So hopefully that comes through quickly. So savings rates compared to disposable income. So during the peak of the pandemic, we were saving nearly 20% of our income. Now we're back down to sort of 10%, which is very interesting. We're saving less, inflation's up, and that's essentially what the RBA want to impact. They want to bring this savings rate down because more people have in the bank, they're more comfortable, they feel, and then more they want to start to spend. And now this is, sorry for that pause, but this is very interesting. Consumer confidence is starting to bounce back up. And this is kind of something I've been waiting to watch for. And so what we can see here in all these years where this consumer confidence has come right back down, we're starting to see that bounce back happen now. I think people are starting to get comfortable with where interest rates are at, starting to feel like, okay, we're nearly at the end of that. And this is a really good leading indicator for many things. The way people feel is ultimately how they act. And so when sentiment is starting to come back, their actions start to take a different course, and that has a flow-on effect to the rest of the economy. So very interesting thing to watch, that this bounce back is now starting to happen. We are at the sort of lower end of that, but it will be interesting to see how that does start to play out. What else do we like to see? So house debt to income, housing prices are still really high. I'm not sure how lagged this data is though. They do get it from CoreLogic and the RBA. Household debt started to have a little taper off, then we would come back up. Household wealth is nearly at sort of 900%. Dwellings is at nearly 700%. And total liabilities is only at 200%, which is real interesting. Housing prices are starting to come down. The ABS though is very lagged behind. I don't think they've had their recordings, but not showing their changes. Loan commitments we went through. I want to look at the NAB business survey. So business conditions are pretty stable at 20 PPT. Business confidence is neutral, and capacity utilization is up, which is really good. What else do we want to look at? I just like wage, credit growth. So owner-occupier housing income is coming down. Investor housing is neutral, and then business credit growth, which means people are borrowing for businesses, is on the way up, which is really good. Wage growth is what I was looking for. So wage growth is now on the way up, so that's sort of above 2.6%. I think the RBA do kind of want to see this get at least above sort of 3%, and that's going to have an impact on some of their decisions that they make moving forward. So it's good to start to see this on the trajectory rate up. I don't know that they're looking for 3%. I just made that up out of thin air, but they did want this to start to tend to trend higher before they make any other decisions. So that's super interesting to me. And then labour underutilization rate. So they are waiting for the unemployment rate to come back up as well, because everyone's employed and everyone's got money to spend. So the underemployment rate has ticked up, but the unemployment rate is still on a very high downward trajectory. We're now closer to sort of 3.2, 3.3% there, which is crazy. The average, the worst unemployment was at nearly 11%. So we are very low with unemployment, which is great, which means people can get jobs. It needs to be in a competitive environment, and wages need to be competitive and not be out of control with inflation and everything else like that. So RBA again is waiting for a tick up in this to sort of decide what they're going to do next with the cash rate. So it'll be interesting to watch. I think that's average housing interest rates. We essentially went from that anyway. Interest. Average housing interest rates. Yeah, we essentially went through this anyway. This is variable rates compared to fixed rates, but CoreLogic has a better graph on that. Yeah, so that's essentially it, guys. Everything else in here is around sort of dollars and other markets and everything else like that. But yeah, it's a bit of a property market chart pack, recap what's happening, or what happened over the month of August, start of September. Very interesting time. Consumer confidence is starting to tick back up. I personally feel like the biggest rate rise has happened. So the last 50% rate rise has happened. I listen to people all the time who sort of predict these things, and I'm like, why are you even saying that? Yeah, so I mean, that's just how I sort of personally feel. Don't take it with a grain of salt. Everyone's got their own opinion. I do think they'll continue to bring up the cash rate, but just not at a 50% basis point increase. Yeah, so interesting time. Not saying it's the bottom of the market, but it is starting to show some signs of turning, especially with those leading markets in Sydney and Melbourne. They have had some pretty aggressive downturns from the peak of the market. I still feel like Brisbane has a while to follow suit, so maybe 6 to 12 months to follow those other markets. But I think as a general sense, with the cash rate and the economy leading the charge, as soon as we start to see unemployment come back up, wage increases starting to continue to increase, inflation starting to come down, they'll start to make decisions around the cash rate. That will make people feel more confident about the economy and ultimately have that flow and effect back into the property market, where those three major capital cities have already had a bit of an impact, and things might start to flow the other way from there. So very interesting things to watch, guys. Hope you enjoyed this. Give me some feedback. Let me know if you want me to continue to do these things, and I'll see you soon.